Stocks get all the glory, climbing, diving and occasionally throwing a tantrum. But what about bonds? Bonds are like that quiet, dependable friend who always shows up with snacks to the party and never causes a scene. Today, we're diving into the world of bonds to show you why they should be your best friend in your investment portfolio. So, what exactly is a bond? Simply put, a bond is a loan you give to a company or government in exchange for periodic interest payments. Think of it like lending money to a friend, except you get to charge them interest and they promise to pay you back. But unlike that friend who forgets to pay you back, bonds are legally obligated to make those payments, which is one of the reasons why bonds are considered relatively safe investments. There are different types of bonds: government bonds, corporate bonds, and municipal bonds. Think of them like different brands of shoes. Some are sturdy, some are flashy, and some are, well, more local. Let's break them down. Government bonds. These are like the dependable, no-nonsense sneakers. Backed by the government, they're usually safer, but may offer lower returns. Corporate bonds. These are the trendier, high-risk, high-reward shoes. More exciting, but can get a bit unpredictable. Municipal bonds, the environmentally conscious flip-flops of the bond world, they're tax-friendly and help local projects. Win-win. Why invest in bonds? Because they're the tortoises in the race against the speedy, volatile hares of the stock market. Bonds are a great way to balance out your portfolio, providing a stable, predictable income stream. While stocks can be wild, bonds keep you grounded. They're like the grandma at a family reunion, calm, stable, and you can count on them to bring homemade cookies. Bonds come with ratings that tell you how safe or risky they are. The highest rating is AAA, which is like the gold star of bonds: safe, reliable, and trustworthy. If a bond is rated BBB or lower, it's considered riskier. It's like buying a used car with questionable mileage. The price might be right, but you might be holding your breath, hoping it doesn't break down in a few months. Now you might be wondering, how do bonds make money? Simple. When you buy a bond, the company or government pays you interest called the coupon rate periodically, usually every 6 months. It's like being paid a tiny paycheck from a super reliable boss who never forgets payday. You don't get a flashy bonus like stocks, but you get a steady income stream, which is nice when you're trying to avoid eating ramen noodles for dinner every night. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices typically fall, and when interest rates drop, bond prices tend to rise. It's like playing tug-of-war. The higher the interest rate balloon goes, the lower the bond price goes. So don't be surprised if bond prices act a little grumpy when interest rates rise. Bonds also come in different durations. Short-term bonds last a few years, medium-term bonds last 5 to 10 years, and long-term bonds can go up to 30 years or more. Short-term bonds are like a sprint. They're quick and usually low risk. Long-term bonds, though, are the marathon runners of the bond world. They can be more rewarding, but you'll need some patience. Buying bonds can be done through brokers or directly from the government. You can also invest in bond funds, which pool lots of bonds together, like a bond buffet. It's like going to a buffet and saying, "I'll have a little bit of everything, please." Bond funds let you diversify without the hassle of picking individual bonds. So, what are the pros and cons of bonds? The pros: they're relatively safe, provide steady income, and help diversify your portfolio. But the cons? They don't offer the explosive growth of stocks, and their value can drop when interest rates rise. So if you're looking for your bond portfolio to make you a millionaire overnight, spoiler alert, it's probably not going to happen. Bonds are a great choice for a well-rounded portfolio, especially if you're looking for a more stable income. If you're risk-averse or nearing retirement, bonds can help provide peace of mind. They're like the comfy, reliable slippers you wear after a long day. Not flashy, but necessary for long-term comfort. So, there you have it. Bonds may not make headlines every day like stocks, but they're essential for building a solid investment strategy. They're reliable, safe, and, when done right, an important part of your financial journey. Remember, investing in bonds isn't about getting rich quickly. It's about getting rich slowly, like a tortoise who's always winning the race without breaking a sweat.